9 a.m. in Beijing, where the heads of the central bank and financial regulators are about to hold a rare joint briefing. This just a day after they cut that 14-day reverse repo. More stimulus ahead? That certainly is a question this hour, just half an hour away from the market opens in Shanghai, Shenzhen, and Hong Kong. You're watching the China Show. I'm Yvonne Man with David Ingles.
Yep, we are waiting with bated breath as markets, of course, looking ahead to potential stimulus announcements from that briefing in Beijing, even as authorities face a high bar for any measures to have a lasting impact. Now, speaking of policy and dovishness, traders are also weighing these dovish commentary coming out of Fed officials, with several leaving the door open for more supersized interest rate cuts. Plus, growing fears of a wider Middle East conflict after Israeli strikes kill hundreds in Lebanon.
Right before that press briefing gets underway, of course, let's do a quick of a market check here. But there is a lot of anticipation that we might get something out of these three here this morning. Certainly, that is what markets are pricing in for. We'll take a look at some of these ETFs that happened overnight, the U.S.-listed Chinese ones, in just a bit here. But stocks, there you go. We're continuing to see this party going post-Fed, and we are actually getting very close, if not there, today, those two-year highs for Asia stocks as well. Japan coming back online and catching up in a big way. We're up some 1% and really reacting to that weaker yen story here as well, with a 143 handle here this morning. Also watching the RBA meeting that could be having not much really in terms of policy settings, but could keep that Aussie dollar pretty bit up here leading up to that. You take a look at how treasuries are doing. We're seeing yields slightly lower here. It really is the Fed speak that we got all the way from Goolsbee to Bostic to Kashkari, seems to be supporting this trajectory of more rate cuts here. Goolsbee sees many more rate cuts over the next year, 2 more quarter-point cuts from Kashkari before year's end. And then we continue to watch very closely what happens with U.S. futures. We're slightly in the negative territory, but Brent markets, obviously, with what's been going on in the Middle East, we'll focus on that just a little bit here. Those Lebanon strikes and iron ore catching about bid here, up some 2%. We mentioned about all these stimulus hopes. You saw that yesterday once they did sort of announce that 14-day reverse repo cut. Yes, it was a catch-up to what we saw back in July. But then again, the fact that they announced this meeting at 9 a.m. prime time, just before markets open, the day before the MLF, that certainly is signs that maybe that they're ready to unleash some more stimulus here. You saw that through these ETFs that track China. From KWEB, the like, was up some 2%. The Nasdaq Golden Dragon was also up more than 1% here today. It sets up for a pretty good open here today. We'll see if there's any sort of news that comes out that the markets react to, but we're already seeing futures punching higher here this morning. CGB yields, the 10 years at a 0.03 handle. That's a record low here right now. CSI 300 is up in 4 straight days. It's the longest win streak we've seen in about 2 months or so. So certainly that's one to watch. And the currency, 705 against the dollar, Dave.
Yeah, I have one eye on my market screens, another eye, of course, on my headlines coming through. As you can see, Pan Gongshan is beginning the briefing taking place in Beijing for what to expect. And by the way, if we do get any headlines coming through, we will get to you as soon as possible. You have the PBOC governor there, plus other Chinese financial regulators beginning the briefing over in Beijing. Let's bring in our team. Stephen Engel, our Chief North Asia Correspondent, joining us from Shanghai. And here on set with us is HSBC's Global Research Greater China Chief Economist Jing to talk us through here. Steve, let's start with you. You're there in Shanghai. Expectations are high ahead of this briefing. As this briefing gets underway, what's being talked about? What could be announced?
Well, it looks like some monetary support. Obviously, financial officials are there. The housing officials are not there. So that kind of waters down expectations that there could be some big bang move for property. There's a little bit of a chatter that there could be some breaks on existing mortgages. But again, with the top housing officials not on the podium there, that would probably lessen that probability, like they were back in May when they announced some initiatives to give some breaks in the property sector. So it looks like, like in January of this year, the last time they cut the RRR requirement, the amount of reserves that are required to be held at banks, they cut that in January. Pang Gongsheng had a sort of a surprise, of course, press conference back then when they were trying to stem the rout in the stock market. Some $6 trillion was wiped out earlier this year. So they're trying to stem the bad news as well here. So just look on the podium. You have Pang Gongsheng. He's talking right now. You have Li Yunzi, the Minister of National Financial Regulatory Administration, and also Wu Qing, the chairman of the CSRC. So you're already starting to see, obviously, overnight, you saw the Golden Dragon Index up. It's up 5.5% month to date. You could see a little bit of course, wind under the wings of Chinese stocks. But again, if they underwhelm, again, we'll see.
Jing Liu, what could overwhelm you? What could satisfy what you're hoping for?
Well, I think today probably we're going to hear a 50 basis point RRR cut. This is more or less expected by the market because the liquidity is quite tight right now. And I think it's also possible they're going to announce that there's this policy which basically says for existing loans to developers, they could extend the loan for 1 extra year. But when they set the policy in July last year, the maturity date of such policy is end of this year. So given the housing market is still under pressure, I think it's likely they're going to extend this further.
What about around reported the lowering for existing mortgages, for example? Is that something we should expect?
I personally think they probably need to assess what exactly they want to achieve.
Hold on a second,
yeah.
We're hearing some lines from the governor right now. They are going to cut that RRR, and the policy rate will lower the mortgage rate for existing mortgage rates as well. So what the market has been wanting, let's take a listen right now from the governor himself.
Of the stock market. First, we will cut the RRR and policy rate. In the near future, we will cut RRR by 0.5 percentage points to provide long-term liquidity of around 1 trillion RMB yuan to the financial market. We will, based on market liquidity, consider the possibility of further bringing down the RRR from around 0.25 to 0.5 percentage points. So this is the policy I would like to announce today. We will also cut central bank policy rate. The 7-day repo rate, this is what we mean by the central bank policy rate. We will bring it down by 0.2 percentage points from the current 1.7% to 1.5%. At the same time, we will guide the LPR and the deposit rate downward in order to ensure the stability of net interest margin. Second, we will cut the outstanding mortgage loan interest rate and unify the minimum down payment ratio. We will guide commercial banks to bring down the outstanding mortgage loans to somewhere around the mortgage rate for new home purchases. It is expected to drop by around 0.5 percentage points. We will unify the minimum down payment ratio for the first-time home purchasers and those who buy second homes. The second home purchases minimum down payment ratio will be brought down from 25% to 15%. With regard to the 300 billion RMB yuan the PBOC launched in May for affordable housing re-lending, the funding support from the central bank will be further increased from 60% to 100% in order to incentivize the banks and other entities to acquire the projects. We will further extend the two policy documents which should have been expired by the end of this year to the end of 2026, which concerns the commercial property loans and the 16-point measure in the financial sector. This is something we do with the National Financial Regulatory Administration. Third, we will establish new monetary policy tools to support the stability and development of the stock market. We will establish swap facilities for securities, funds, and insurance companies. We will support eligible companies in securities, funds, and insurance companies through pledged assets to obtain liquidity support from the central bank. This will increase the access of funding for these companies and their ability to increase holding of shares. We will also set up a special relending program for increasing the holding of shares. We will guide the banks to provide loans for listed companies and its major shareholders in order to support their efforts for share buybacks and increasing the holdings. We will release the policy documents on the PBOC website in the near future. So this will be my opening remarks. Together with my two counterparts, I will take your questions. Thank you.
Thank you, Governor Pan. I now give the floor to Minister Li. Thank you. Good morning, friends from the media. It is my pleasure to meet with you all. First, on behalf...
There you have it, the unleashing of stimulus there from the PBOC Governor Pan Gong-shen himself here, sort of echoing what we saw back in January here. And this is basically what we heard. So triple R cut by a half a percentage point soon, as he said here, a 20 basis point cut to that 7-day rate cut to 1.5%. And outstanding mortgage rates also cut and in line now, similar to what we're seeing when it comes to the mortgage rates of new homes. That is the summary of what we get so far. Markets are certainly reacting. We talk about China futures are rallying hard. Right now, we're seeing a spike up in dollar China and those China 10-year yield now at 2%, which is a new record low. Markets are reacting. Jing Liu, your reaction so far?
So I think this is basically to ensure this year China can deliver the around 5% growth target. With the stronger support now, I think we're going to see basically some kind of a lifting effect. And also, I think he also says it's possible the PBOC can cut further 25 to 50 basis point of triple R. Actually, we forecast another 50 basis point cut in the next year. I think what's also important here is he announced that they're going to extend the policy until 2026, which basically allow the banks to extend the loans to developers. Given that the housing market is still under pressure, I think this is very important.
Steve, let me bring you in. Steve, what stood out to you?
Well, again, it begs the question, is this enough given the stresses in the economy right now and just 3 months left and change before the end of the year, and of course to reach that target of growth of about 5%. And again, you know, there's been about $18 trillion worth of household wealth wiped out by this property crisis. People are not necessarily incentivized to buy. Will this be enough to do that? And that would be my big question. Maybe, Jing, you can address those concerns.
Well, I think to deliver this year's growth target may be not that hard given today's policy announcement. And don't forget, we still could have further fiscal stimulus. Today, there's probably no point of announcing that yet because we still have more than 1 trillion quota left to be basically used up this year. And there's still possibility, if needed, the Ministry of Finance can issue more treasury bonds. And I personally think they will likely to use the ultra long-term special treasury because that one does not change the official deficit. And also at the beginning of the year, they already leave room for more operation of that.
The composition of the officials on stage right now, and again, we have to emphasize, this is quite rare that this is actually a live briefing that they're taking questions. You have the PBOC governor on the screens here is the banking regulator, Liu. We were talking earlier on the CSRC chairman, Cheng. What do you think he could add to? Because I believe he's yet to speak.
Right. So just now, actually, Governor Pan Gongsheng said PBOC will directly provide funding to brokerage firms and other kind of fund management companies. This is quite an unusual movement, which means the PBOC actually can provide the low-cost funding to those players in the stock market. And probably Wu Qing will announce more details in terms of how they want to make it work.
What do you make of the communication? The timing of this, we talk about this as live. We rarely hear them live speaking to reporters, and we're broadcasting it at 9 a.m. Beijing time. The transparency factor, how big of a factor is that for you now?
I think, so this is one of the rare moves. Probably going forward, we're going to see more of such kind of press conference because there's quite some emphasis on transparent policy making, on improving the communication with the market. So I think the more the better.
Yeah, okay. In fact, this line just crossing right now, and we were alluding to this, that Pan Gongsheng announced that China will be creating a new monetary policy tool for the equity market. Among the many things, of course, that have been announced here so far. Yvonne, anything stand out to you still here?
No, I'm just looking at right now. So it looks like there's talking about more tools for the equity market, right? Certainly there needs to be some sort of support. We have been talking about how state-backed funds are trying to at least support this market right now, but we're still talking about one of the worst markets this year, which is China. And the foreign investors are still not convinced of this sort of recovery story, which has basically hit the skids of late. So we're watching very closely what goes on here. But yes, I think today is quite a telling signal here that there is urgency. There's urgency to respond finally here after what we've been saying. Jing, anything
I just recall that back in 2015-16, when there was this massive market correction in China, actually PBOC also essentially wrote a black check saying that they will support whatever needed to stabilize the market. So this is, to some extent, mirroring that movement, but this is a long-lasting new monetary policy tool.
Right. Steve, let me bring you back in here. I mean, the fact that we're getting something akin to almost, if the Fed was a topic of the markets last week, and if the Fed went 50 or even bigger than 50, the markets would be worried, was there something the Fed knew that the market didn't? In this case, would you say this is a positive move from Chinese economic officials coming out with something larger than what we were expecting?
Yeah, absolutely. And again, on Yvonne's point, I think the transparency is very important as well. They need to do this more often, if you will. They don't have necessarily an FOMC meeting where, the speculation then can be either, quashed and dealt with directly. We get statements and broad brushstrokes from the Chinese government officials. Look what happened since May when we got those housing announcements. The markets were up. I mean, the CSI 300 was up at a, year-to-date high in, May 20th. But then it just started petering out because the details were not coming out. This is an opportunity for these three officials, and Wu Qing is speaking now, the CSRC head, to kind of outline their policy stance and plans, at least for the rest of this year. And perhaps this could be a more regular occurrence to give a little bit more transparency to policy moves, which obviously move the markets.
Yeah. Steve, as you mentioned, this is rare. Let's get in straight, of course, and listen in to Wu Qing, the CSRC chairman, speaking in Beijing right now.
In 2023, listed companies paid a total of 2.2 trillion RMB yuan of dividends, a historic high. We are also strengthening regulation oversight over computer-driven program trading. We suspend re-lending. We are also deepening reform on the mutual fund fee rates to encourage relevant institutions to prioritize their original functions. Third, the market functions is being leveraged. We have overcome difficulties to ensure the tempo of IPO and refinancing. We are also increasing the effectiveness and efficiency of managing companies filing for overseas listing. We are stabilizing the functions of the bond market and futures market. In the first 8 months, the EBM saw a total of 8.9 trillion yuan of all sorts of bonds. Fourth, we are deepening reform with determination. We focus on the 5 key areas. We have released and implemented the 16 measures to support the tech companies through the capital market, as well as the 8 measures regarding the star market. We are also giving a more important role to M&A and other restructurings. Since May this year, we have disclosed around 50 major restructuring cases. The third plenum of the 20th CPC Central Committee also made important strategic plannings for deepening the capital market reform. The CSRC will continue to strengthen our regulation oversight to facilitate development and stability. We will shore up the capital market function by enhancing their role for investment and financing. The first is that we will highlight the internal stability of the capital market. We will enhance the quality and value for investment of listed companies to better serve investors. We will build a policy framework which enables long-term money for long-term financing and investment. We will also further improve our policy toolkit and guard against risks. Second, we will better serve the real economy and advance high-quality development with a particular focus on key areas such as new quality productive forces. We will make use of stocks, bonds, and futures, among other capital market tools, to invigorate the restructuring and M&A market. We will roll out and release relevant measures in the near term. We will also work with other sides to ensure that PEVC firms perform smoothly so that they can raise funds, invest, manage, and exit properly. Third, we will protect the legitimate rise in interest of small and medium-sized investors. We will crack down on financial fraud and other illegal activities. We'll also put emphasis on representative action and advance indemnity so that we can demonstrate our determined efforts. Thank you very much. Thank you. Now the floor is open. Please identify your media affiliation before raising your question.
Live press briefing out of the top Chinese financial officials in Beijing. They're taking questions. They have just announced, in case you missed it, multiple rate cuts, a reduction of the RRR of banks here by 0.5%, a reduction also in the borrowing costs as far as existing mortgages are concerned, also a new tool, monetary policy tool, as it pertains to the equity market. Markets are listening. 7 minutes to the opening bell, we're getting a gap higher across the benchmarks here in Hong Kong, 2.4%. Virtually every single stock on the Hang Seng China Index is set to open higher this Tuesday on the back of all these announcements so far. Yeah, if you go to T-Live Go, you can read the commentary, and it's from our China team, EcoGov. Both are saying, wow, we can't believe this is happening in front of us here right now. Who else is in front of us? Chairman Systermans, head of Asia Multi-Asset at Mercer. He joins us now to walk us through. It seems like the market was anticipating something. Do you think this met expectations, or actually are we talking about a bazooka here?
Yeah, I think based on the details that we've seen so far, it looks like a bit of an upside surprise, and certainly, the signaling impact is quite important here. I guess, so far a lot of investors have been a little bit disappointed about the policy announcements and the flow through that we've had over the course of the year. But certainly, this looks like a good start. I guess the details, still need to go through that a little bit more. But certainly, from the way I see it, maybe the markets were set up for an upside surprise as the expectations. I guess yesterday there was some positive news, but before that were quite low coming into this. Having said that, I think, more so from the monetary side, but I think if we had more fiscal policy stimulus, that would certainly be more important in really driving activity here, given the low level of confidence amongst a lot of households and also businesses in China, and obviously, very high household savings rates right now.
Yeah, I mean, there needs to be, to your point, there needs to be a stopgap measure to address confidence among investors and obviously buys time for them to then fix the underlying issues with the economy. Do you think this goes as far as being able to at least chip away at that risk premium that's been built into what? It's almost a 4-year bear market now onshore.
Certainly, yeah. And I mean, the signaling impact and bringing, giving foreign investors the sign that they are actually doing something and conscious of the downside risks to the economy in China and really willing to commit to hitting their GDP targets, I think is an important signal. But as we've seen, in the past, that they do need to get the follow through into the actual, economic activity.
Yeah. Steve, chime in. Any more takeaways?
Yeah, I mean, We'll definitely have to see how the foreign investors react to this. There was some encouragement overnight, obviously, in some shares. But keep in mind, in the second quarter, a record amount of foreign investors' money came out of China. I was just at the International Business Leaders Advisory Council here in Shanghai a couple of days ago. And Dominic Barton of Rio Tinto, the chairman, he was actually talking up quite a bit about the opportunities in the IPO market and that foreign investors potentially could be looking again. Medea had that big $4 billion, obviously, IPO in Hong Kong. There could be others, obviously, big ones in the pipeline. We heard the CSRC chairman, Wu Qing, talking about the IPO market. Also, they're talking about measures to support mergers and acquisitions. Deal flows, we know, have been very, very muted, but he did not provide much detail. So I think everybody's watching this quite closely. In fact, James Mager, Yvonne, you mentioned that Top Live blog. He used the word bazooka. He thinks this is a bazooka from these officials on stage.
Yeah, he said his fingers were trembling as he was typing those headlines. Yeah. I think when we were reading them, we were all surprised.
He's not alone.
That says a lot coming from James Mager. Cameron, though, I have to wonder, though, given this is on the backdrop of the Fed just doing a massive rate cut, there seems to be this whole American exceptionalism theme that is fading away in some ways. Is that sort of the way to pivot now?
Yeah, and I guess that's consistent with our view. I think certainly over the course of the year, you have had the US economy being quite strong. And for what it's worth, we do think that the US economy will remain quite strong. We're in the soft landing camp. We don't think the US economy is heading for a recession. Nonetheless, I think what we're seeing is that where other major economies had been a little bit softer so far year to date, think Japan, the Eurozone, and so on, they should pick up, whereas the US growth should slow to something more in the sort of 1% to 2% range. So slightly below trend, but enough to really, keep things on track and obviously continue to support reasonable gains for equities as well.
Yeah, Jing Liu is still head of business, of course, out of HSBC. We've heard almost as much as this group, this trio could, the mandate, what they're overseeing right now. What are the next things to watch outside of these officials on stage? And also, what would be the indicators that you think might first start to show any reaction to what was just announced today?
So I think what else to watch is basically, whether China can have the PPI inflation turning positive relatively soon. Because there's some sectors suffering from excess capacity. Beijing already rolled out some measures trying to facilitate consolidation. And just now, when Wu Qing said there will be measures to support merger and acquisition, maybe this is consistent with the effort to reduce some of the capacity. For example, in sectors which clearly have been affected by the housing market, probably there's some room.
All right, we're getting some more lines crossing here from the governor. So further RRR cuts by year end, and depends, though, on the market conditions here. But yes, they might lower the RRR again by 1/4 to 1/2 percentage points. They're giving pretty precise sort of numbers here, Dave. And even when it comes to the LPR deposit rates, to also go down by 0.2 to 0.25 percentage points as well. We're seeing property stocks really rallying.
We're up 2% now. That group is up, I think, 5 or 6 straight days at this point in time. It now begs the question on the limits of monetary policy. And do you think, Jing Liu, we're almost at that point where fiscal needs to start picking up right now?
Yeah, exactly. I think the monetary policy has done a lot according to today's announcement, and we probably would like to see the next move, in particular, what China can do to stabilize the housing market. And I think they have tried some measures which essentially encouraging the local government, the financial institution, and developer to work on the projects to ensure delivery. But maybe the next move would be the central government directly putting money into it and to make it work.
Exposure to China, what do you have now, right now, Cameron?
Yeah, so within our portfolios, we are overweight emerging market equities, but that's from a sort of a global emerging market equity standpoint. I guess China is about 25% of the MSCI Emerging Markets Index. But that's also driven by views not just on China, but about emerging markets more broadly. So certainly, from China's side, that yes, growth has been a little bit disappointing, but I guess this announcement today really does highlight the commitment that authorities do have to resolving issues, and then therefore maybe the potential for surprises being skewed to the upside as we've seen today. Obviously, valuations are quite attractive, and to point to comments before that a lot of international investors are underweight China as well. But more broadly, outside of emerging markets, we also obviously there's a lot of positive talk about structural and cyclical tailwinds in India, of course, and in many other parts of emerging markets that generally the easing in monetary policy, as well as the easing of the Fed starting last week, all really, are tailwinds for emerging market equities.
Steve, chime in.
Yeah, I think what Jing mentioned about M&A as well as deflation. Keep in mind, producer price index factory gate deflation has lasted for 23 consecutive months. It's probably going to be now 2 years come November. That's the longest streak since 1999. And so that does play into the theme about M&A and whether this is going to be absolutely encouraged, perhaps a little bit nudged to get rid of the excess capacity and the too many players in places like EVs, batteries, solars, the new three, if you will, so they can take out some of the excess, not only capacity, but the excess competition and return profitability to these sectors right now. So that's something that you asked what's next. That's a good follow through on what kind of M&A and consolidation we could see in the industrial space and reduce some of that excess industrial capacity.
Yeah, okay, so we're about almost 2 minutes into the cash market open, and as expected, markets are reacting very positively to all these announcements coming through, and these announcements, by the way, are still trickling through. So as far as Hong Kong markets go, we're up about 3% on the Hang Seng Tech Index. Hang Seng is better by 2.5%. I have yet to look at market breadth so far, but I would imagine almost everything, if not everything, is up on the major benchmarks. They're up CSI 300, 1% to the upside. Shanghai Comp, Shenzhen Comp, as you can see, your 10-year yield is at about 2%. And some of the more specific 10-year bonds. And by the way, we have something like 360 billion as far as CGBs that are hitting the markets today out of the Ministry of Finance. So keep an eye on how these yields at these levels affect demand for these auctions coming up today. Guizhou Maotai up 2%. Flip the boards, please. Have a look at where we are in Hong Kong. And the 2.4% gains we're seeing as far as that is concerned. On your screens, Tencent is up 1.6%. Hang Seng Tech should be, there we go, about 3% to the upside here. Very quickly, flip the boards, please. So, I mean, we can get to some of the idiosyncratic stories in a moment here, but we'll talk about this a bit later on. Aoyuan was actually up substantially.
As much as triple digits yesterday.
125%.
Yeah.
Up further 11% today. Obviously, we're getting a bid coming through across the property sector on the back of two things that were announced, right? A lowering of existing mortgage rates, and on top of that, direct financing, or financing at least, from the banking sector to the property developers. And some of the brokerages, this was really came somewhat out of the blue, the announcements here around these new tools here.
Yeah. To boost the equity market.
To boost the equity market, well, somewhat indirectly to boost the equity market. But
yeah. So certainly that's some surprise, as we talked about here. You can take a look at what else we're watching out for. Can we go back to the one mini show? That stock was plummeting just now. It's getting a double downgrade on the ADRs from Bank of America overnight. They're taking a big stake into Yonghui supermarket stores. in which the market's interpreting that as a bad idea, it seems like right now. But yeah, we saw the ADRs plummet. We're falling back through here today. Yonghui shares, though, for example, are all going the opposite direction and actually doing quite well. Anyways, that's beyond the point of what the big story is here today, which is basically this sort of surprise that we got from these markets, and certainly when we continue this discussion here, we're hearing a little bit more. So Pang Gongsheng talking about what impact this could have on the banks. So yes, we are talking about more room for policy rate cuts across the board, but what impact it have on the lenders' net interest margins, they say, to remain basically stable in light of all of this as well? Maybe I can ask that question to Jake. Should we be worried about the banks?
Well, I think, it's probably not a secret. Some of the state-owned banks sometimes will need to support certain policy agendas, such as the local government debt restructuring, etc. So for a while, the banking industry argued that they need to maintain certain level of net interest margin. And clearly, Pang Gongsheng today said they will guide down the deposit rate as well, such that they can keep the net interest margin relatively stable for the banks.
The lingering question is whether what has been announced and what is coming and what has already been announced is enough to nudge China away from the direction Japan headed in 30 years ago. Do you think this prevents China from sleepwalking into somewhat this demographic deflation challenge, or do you need to see more? And I'll get your thoughts in a moment, because I know you think Japan has actually turned the corner as far as that's concerned. Go ahead.
I think we need more. So these aggregate policies, monetary, fiscal, are more in the cyclical nature, trying to boost growth for the near term. For the longer term, if we need China to switch on to a more sustainable growth path, we need a structural reform. And actually, the third plenum, the resolution, include a lot of major reform agenda ahead, which could actually take China into a healthy growth path.
There we go. Cameron, and hopefully we don't get there as far as China goes. We don't want to wait. If it does, we don't want to wait 30 years until we get there. What's changed in Japan, and what was the catalyst?
Yeah, so, I mean, obviously Japan did take a long time to get out of this sort of deflationary period. But I think the things that really kick-started it were around 2022. Obviously, at that point in time, you had the Russia-Ukraine conflict kicking off that led to a surge in commodity prices, and at the same time, really a tumbling of the yen. And what changed there was, I guess, it did lead to corporates passing on the, costs that they're facing onto their end consumers, and ultimately really kickstarting that inflationary process in the economy. If you recall that for much of the period since the bubble burst, right through, into the early sort of 2020 or so, that whenever there was an increase in companies' cost bases, that they typically absorbed that into their margins. And then so by finally, passing that on to the consumer, and then a lot of these companies sort of noticed that it didn't really have much of an impact on, their bottom lines in terms of negative competition, or their, basically a lot of their competitors did the same thing, and companies realized that they could then go through subsequent price increases. And then what really got that moving again was from 2023 with the annual spring wage negotiations. We also saw very strong numbers this year, was that companies were now showing that they're actually going to increase wages that their employees are getting, after being more or less stagnant for much of the past 20 years. And so that's really kicked off what the BOJ, Governor Ueda, is talking about as this sort of a virtuous cycle between prices and wages, which is becoming quite sustainable, and therefore means that, the Bank of Japan's 2% inflation target is, achievable on an ongoing basis going forward.
All right, I just want to bring it back to China a little bit. My final thoughts here. Obviously, now that they've opened up the toolbox and have unleashed some of these tools, we have to see how this plays out and whether the confidence is still there. I just want to read one comment from Raymond Young. He's the chief economist over at ANZ Bank. He says this stimulus is too far from being a bazooka. So he's maybe a little bit pouring a little bit of cold water on what's been, fairly well received, obviously, off the bat. If the mortgage rate is down by 50 basis points, he says, households will save 190 billion yen, but they would turn into consumption of only 66.5 billion yuan. The 7-day reverse repo rate cut also implies a parallel move of the MLF tomorrow. The triple R cut is a complementary move to lower banks' cost of funding. We are not sure how much the mortgage rate cut will induce a property recovery. So maybe just the beginning of more measures as these officials here on the stage are offering up a little bit of transparency, but now its implementation is the key.
Yep. Lots to watch out for still. Fantastic. We're 40 minutes into the show. We haven't taken a break. We'll take a break very, very shortly. Markets are bid substantially. Thank you so much, Stephen Engel in Shanghai for us, a Chief North Asia correspondent. Here in set in Hong Kong, Jing Liu, Greater China Chief Economist at HSBC Global Research, and Cameron Systermans, Head of Multi-Asset Asia at Mercer. Plenty more ahead here on The China Show. Good morning.
We will cut required reserve ratio and policy rate and guide the market benchmark rate downward. Second, we will lower the mortgage rate for existing housing loans and unify the minimum down payment ratio. Third, we will establish new monetary policy tools to support the stability and development of the stock market. In the near future, we will cut RRR by 0.5 percentage points to provide long-term liquidity of around 1 trillion RMB yuan to the financial market. We will, based on market liquidity, consider the possibility of further bringing down the RRR from around 0.25 to 0.5 percentage points.
And that, of course, just took place this hour. The PBOC Governor, Pan Gongsheng, announcing a series of steps to boost and aid this economic recovery. Markets, as you can see, 12 minutes into the session here, are catching a very strong bid, particularly when you look at developers and also some of the brokerages, given some target announcements along those lines as well. But it really goes to show at the end of the day, this has to affect consumption and consumer spending, consumer confidence.
It should. It's interesting. I mean, we didn't get anything more in terms of the fiscal side of things, right? Where you talk about housing policies and you didn't get the Ministry of Finance there. That is what was probably lacking in this press briefing. But the easing of lending conditions, I'm guessing, is going to help the consumer in some way as well, which basically has been in the doldrums as well. Let's bring in Michelle Cheng, co-head of Asia Consumer Research at Goldman Sachs. Was there anything that you heard just now that might change your view on how this whole consumption story evolves?
Yeah, so on the positive side, we definitely need policy support. So from the liquidity perspective, from the fiscal policy perspective, definitely when the expansion is so low, this could boost the sentiment a bit. However, we definitely need to see more. And on the positive side, if we look at the past few weeks trading for some sectors like home durables and also like autos, given the trading policies started from around August, it actually helped a little bit. Yeah, so that's definitely from a very easy base perspective, this is positive. But having said that, purely looking at the fundamentals, we just wrap up the second quarter result, and there is initial comment in July, August in our conference 2 weeks ago. Consumer companies basically talk about pretty challenging environment, especially from June, July, August. So aggregate data perspective, second quarter, the reported companies, the companies in our coverage reported revenue only grow 5%. Versus 14% growth in the first quarter. So looking ahead, second half base is easier, yeah, but definitely confidence level I think is still quite low at this stage.
Fortunately, the base is easier, I think, as a starting point, right? Talk to us about, and you guys cover many subsectors, and within the subsectors, there are idiosyncratic stories as well. What are the subsectors you're most bullish on at this point?
Yeah, great point. I think, firstly, to talk about this easy base, why people get a bit frustrated in the recent announcement or result is in June, July, some sector already entered the low base period, like beer consumption, but it actually miss on the low base. Yeah, so that's why there's actually increasing concern about when we enter the easy base in fourth quarter, whether company can really deliver this rebound, another rebound. Yeah, but you're right that we don't want to be that over that negative. There is still some idiosyncratic stories. We see a diverged trends even within the same sectors. Yeah, so the highlights, I think one is travel is still more resilient. So looking at 5% consumption growth, travel is still growing at 7-8% versus goods consumption 2 to 3%. And secondly, some experience-related consumptions, partially also related to travel, so like outdoor spending, outdoor apparel, even it's super expensive, selected brands is still doing really well, 20-30% growth. And in staples, beverage consumption is actually pretty good. This probably also related to when you travel, you actually consume more beverage during travel. Yeah. But also, I think we also see some strong local brands doing really well in cosmetics. In cosmetic space, you hear like Estee Lauder, L'Oreal, Shiseido. They also comment pretty negatively in China.
Yeah.
They have, yes.
Yeah, but you can see Proya, Giant. They are still performing very, very decent numbers and even guiding up.
This consumer trade-in policy, and people say that this is something that could actually help. How much do subsidies help in really helping to recover from the sector? And what sectors actually benefit the most from this policy?
Yeah. So for the most recent statistics, for auto, our team was visiting some distributors in Shenzhen, Guangdong a few days ago, and they said that for some mass market brands, they have 10-20% incremental consumption. And for home appliance, so far, white goods, air conditioner, they are seeing the most impact. So if we look at purely offline data back in July, August, it was negative. But in late August, actually, it made the whole August number turn into a teens levels growth. So we do see some impact. But of course, you can always argue that whether consumers just advance their spending from next year to this year, or it probably squeeze out other consumption. But I think ultimately, if there's something incrementally getting better, I think that's still a good thing.
You guys read a whole piece here about deconsolidation. What does that mean?
Yeah, so this is actually a very good, interesting topic. If you recall, in the past few years before COVID, two important drivers for China consumption. One was premiumization. One was actually consolidation. Big companies, they are gaining shares nationwide because they have resources to expand. But in the past few quarters, we actually see some reverse of this trend. So, for example, if you look at restaurants, the above designated size restaurant companies, their revenue growth is below the average. And also in sportswear, we are seeing that the big brands like Nike, Adidas, they underperform some niche brands like Arc'teryx, Descent. And in cosmetics, MNC brands like L'Oreal, Estee Lauder, they used to dominate. The growth rate is much smaller. So the thing is, that's why we construct a framework to evaluate the trend. So we think there is actually a few drivers to impact this consolidation trend, including like channel disruption and deflation, and also the lower initial input costs, and also this margin. And specifically on this deflation, one thing I think there was a stereotype that big companies, they should have better cost control. But the thing we observe recently is in some categories like restaurants, even like dairy, sometimes the the smaller players, when there was deflation, they actually have a much lower cost to compete. So that's why big players, they didn't really benefit too much in the past few months down cycles.
Yeah, you have a very complicated matrix here. Exhibit 1, page 3 of the many reports. Thank you so much, Michelle Cheng. We could be here for a long time. Let's do this again, Michelle Cheng there, co-head of Asia Consumer Research at Goldman Sachs. Right, let's stay with markets right now. We're looking at markets just coming off highs a little bit here on the Hang Seng Index and the CSI 300. Let's bring in our Asia stocks reporter, Jeannie Yu, to talk us through, of course, some of the trends we're seeing as far as ETFs go. But before that, though, if you could just have a look at how surprising do you think these market moves are, given what we heard this hour from monetary officials?
Yeah, I think like since yesterday, there were so many market chatters about all the rate cuts, RR cuts, and I think many of those are kind of expected. But then in terms of the PBOC is going to allow those brokers, insurance companies to tap the PBOC funding and then to buy stocks or conduct buybacks. I think those policies are really upside surprises for the market. So right now, we're seeing like property brokers, they're doing quite well, and then Hang Seng, CSI, they're all up. So and then then people start to kind of talk about, how much actual money is going to be brought to the equity market because of this new move. And then I think these are all the things to watch out for. And then for the RR cuts, people start to talk about, we're going to have more through the remaining of this year. Every 50 bips RR cuts is going to bring 1 trillion to the market. To the money markets. Those factors are actually very needed, a very timely help for the market, which has been stuck around the low level for quite a few months.
Yeah, I mean, you talk about this relentless slump that we've seen in Chinese equities. There's one corner of the market, though, that you've been tracking has been doing quite well. It's the surge in these ETFs. What are you seeing?
Yes, I think part of the driver is, of course, the national team, as we have talked about. Like they have been the major, one of the major buyers of those ETFs in the market. I think the other more longer-term shift, a more important driver is actually the changing behavior of the retail investors. China is very different because retail investors account for more than 80% of the market turnover. So I think their mindset actually changed a lot because after seeing all the star fund managers, they lost so much money over the past 2 to 3 years. So more like gradually they all shift towards the passive investments. So nowadays we are seeing ETF actually accounts for almost half of China's total 8 trillion market cap. And US actually has like about 60%. So if you compare, the gap is not really far away from the US level, which is a very mature market. With the sluggish market performance and with the pledged further buying by the national team, we're going to see this ratio to keep rising.
Jeannie, thank you. Jeannie Yu there, Asia Stocks reporter, watching all things China here this morning. Of course, we'll get you a market check coming through here. As Dave mentioned, we already are seeing, we're pairing off some of the gains from the initial press briefing. And this sort of, is this the real deal is what the question is here today. Eric Zhu from our Bloomberg Economist says this is a day to remember when it comes to China monetary policy. This is Bloomberg.
All right, here's your paradox, or is it an automatopoeia? I forgot what it is. Indicates, of course, property stocks off the ground, as you can see, flying in some cases after the PBC announcing a series of measures to aid the housing sector. Although, a reminder from Governor Pan, don't go to the bank this afternoon to check on mortgage rates. It will take time for these things to seep through. Plenty more ahead.
Welcome back to the China Show. Here's a look at the HSI just a half hour into the session. That press briefing still underway in Beijing. More than an hour, close to hitting 1 hour mark there. So certainly they're taking all these questions from reporters. It is live. And this is something, as Bloomberg Economics' Eric Zhu says, a day to remember when it comes to China monetary policy here. But we rarely see all three of these regulators and, of course, Pan Gongshun, the governor here, unleashing the stimulus blitz here, everything from RRR cuts, mortgage rates, and the like, Dave.
Yeah, well, we rarely see Eric Zhu impressed. So the fact that he's almost...
And James Mager.
On the fence, and James Mager, our other colleague as well. For our Bloomberg clients, you can check out our ongoing blog on TLive We Go, which means that this ongoing briefing, it is rare in terms of timing, it's rare as far as who is involved, and it's rare as far as what was announced. Markets are bid, we're up 2%. We're coming off high, so a little bit I should also note. CSI 300, CSI 500, CSI 1000, and small caps all the way up to the 2000 benchmark. Looking like this 30 minutes into the session here, we're up now 0.5%, give or take. We were up as much as 1% in some cases. Property stocks in focus were up 5 or 6 straight days on this. A lot of speculation in the markets yesterday after it was announced. Well, after today's briefing was announced, what was taking place. I think we're up still on all, if not most, of these property-related stocks on your index. I think we have them coming up on your screens. Can we get that up, please, if we can? The Bloomberg Property Gauge, MOV Go. Do we have it? Okay, well, if we don't, let's skip ahead and have a look at where we are as far as the regional benchmark is concerned. Oh, there we go. So we should be looking at most stocks on the way up, mostly on green. The benchmark is off highs as well. As far as Asia goes, flip the page, please. I'll make this very, very simple here. We're now trading, because of the rally in Hong Kong, we're now trading at the highest level on the regional benchmark. We touched it earlier on. I believe we're still at about those levels, highest level here since 2022. Whether we close Tuesday at that level remains to be seen, but certainly the PBOC and other officials there have given us a lot to talk about this morning.
Yeah, and let's get a little bit more of what the BE take is, right? This data, remember, according to Eric Ju, what he said was there was, if you add everything, the sum of the parts together, that's what makes this significant, right? This will give the much-needed boost to sentiment. Their baseline forecast was 4.7% growth for this year. This powerful package of monetary stimulus, he thinks, suggests growth could approach that 5% target. Those are similar words that we heard from Jing from HSBC too just a few minutes ago.
Yeah, very impressed by the... we were expecting, I think the broad expectation was we would get one or two big announcements, a triple R cut plus something else. What we did get was those, and then other things coming through as well. And I think if you aggregate everything so far, what we've heard, and the indication is the current consensus of 4.7%, there is upside risk to these forecasts, given what was announced. Now, I guess a bit of context, too, and we'll get more in a moment here from our team, for our viewers here. So we're getting, well, you have three top officials in Beijing right now. You have the central bank governor, you have the banking regulator head, and you also have the securities head as well. So effectively what they can announce was announced today. Those that, of course, are under their mandate.
Yeah, let's bring in our Chief North Asia correspondent, Stephen Ingles, in Shanghai. Also joining us now is Hao Hong, Grow investment partner and chief economist as well. Steve, I'll start with you. Obviously, this is, what a day. I think for some economists, this is a bit of a surprise of what we got.
Yeah, I think we got probably more than what we were expecting, but our expectations have been fairly low because they've been doing such piecemeal approach to policy moves. Is it a bazooka or not? I don't know. You can have the biggest bazooka on the battlefield, but it still has to hit the target, right? And you can add all that firepower, but again, it has to hit the mark. And again, so far, if you look back in May when they had that so-called property rescue package that was announced, it didn't necessarily hit the mark. It did not put a floor on the property market. And the stock market reacted as well. The CSI 300 is down 13% since May 20th, since we had all that hoopla around property. And I think that is still a crumbling pillar of the Chinese economy that needs further policy support and sentiment boost because of those households in China who have lost about $18 trillion in household wealth through these years-long crisis in property. I don't mean to be the wet blanket here, but again, we're going to have to see whether Pan Gongsheng and other officials come through on their pledge to do more stimulus, more easing on data-dependent needs, right? So we have 3 more months left in this year to kind of stimulate a way into that growth target of around 5%. They can probably hit that on the margin, but again, is it going to restore the confidence? Some positive, better than expected moves today. Now I throw it forward to see the implementation.
Hao Hong, I'll bring you in. Your initial prognosis, sir.
Yeah, well, I think some of the policy announcement today is above expectation. Even though I think many people were expecting a triple R cut, but I think the cut was happened before the expectation in terms of timing, right? So they actually bring it forward, and also there's another related announcement about letting the fund management companies to borrow money from the central bank to buy stocks, even though we don't know how much liquidity there's going to be, and also how many fund management companies going to borrow the money to buy the stocks. But I think it's from a sentiment perspective, it's going to help as well. And I think today's announcement comes at a critical junction in the sense that the stock market last week plunged to a level not seen since February this year. If you recall, back then there was a quake, right? So the Chinese stock market was plunging very heavily, and it's, I think, one of the most oversold conditions in recent years. And I think now the market is sort of hovering around that level, and that's sort of giving you a key technical level for a technical rebound.
How long? I'm just wondering, the fact that there wasn't anyone from the Ministry of Finance, we didn't get anything in terms of fiscal policies here. The fact that we're still getting that mortgage rate cut, are we approaching that sort of limit of how far monetary policy can go in supporting the housing market now?
Yeah, I think the RRR cut is completely within the jurisdiction of PBOC, right? So the PBOC doesn't have to consult anyone, for such a cut. But I think the fiscal policy is indeed, you're right, much slower than expected. I think for this year, the bond issuance quota still quite a bit of left, still being unused. I think it's in the magnitude of 3 trillion yuan or above. So I think that is sort of holding the fiscal stimulus back, and also at the same time, there was if you remember, there was a PBOC relending for money for the ministry to buy up excessive inventory in the property market, but for some reason, the 300 billion yuan isn't fully utilized just yet, and also that's room for more sort of execution there as well. So I would say that physical side we can do substantially more. I think monetary side is a good sign that the PBOC is cutting aggressively.
There was also another measure announced today. I'm not sure if you're able to see that, Hao Hong. Let me just read that for our viewers as well, just in case. So the central bank has now set up a swap facility that allows brokers to tap the central bank for funds to buy stocks. And what do you make of that move? What do you think it is? And I know we've asked this question before, and so far the market's gotten this one wrong. Does this finally put a floor underneath these equity markets, Hao Hong?
Well, I think the level that we discussed just now, around 2,600, is a key technical level, right? So with this kind of policy in place, it bounds to help out. But then at the same time, there isn't that much sort of details regarding the swap tour from the PBOC. I think during the 2015 stock market crash, they used a similar tool. They set up a company called Cheng so to lend money to the brokers and fund management companies to buy stocks. That was back then. I think this could be a similar facility, aiming to support the market. But I think because right now the market risk sentiment is very weak, and I think the housing issue is far from being resolved. So it remains to be seen, how much extra liquidity can come out of this facility.
Hao Hong, there was a lot of, I guess, forward guidance from the governor of just how far they can go with RRR cuts, that this is something that goes beyond 2025. It really sort of defines what the communication sort of strategy that Pan Gongsheng has laid out since the start of this year. What do you make of that sort of transparency?
Yeah, I think he's indicating that there would be more cuts coming towards the end of the year, which we think it's a positive development as well. It's actually giving forward guidance on where the RRR rate is going to go. But then at the same time, I think RRR is a sort of an absolute instrument for managing interbanking liquidity. And I think right now, the problem is that because of the property crisis is still unresolved, so people's willingness to borrow from the bank is actually quite limited, right? So even if you cut RRR substantially and release or unleash the capability of the bank, the commercial banks to make new loans, the problem is that the loan demand is still very weak. So I think this set of policy is good, it's favorable, but I think it's going to help technically and also on the sentiment. But I think in terms of reversing the housing downtrend is far from being enough.
Hao Hong, Steve up here in Shanghai. Good to see you. I'd like to ask you a question, whether you think this is an indication that maybe, Pan Gongsheng and the PBOC is kind of getting a bigger voice. I mean, we know back in January, he called that special press conference as well when they first cut the RRR. I was there at the National People's Congress in March where, Pan Gong, I have to be very honest, he just sat there kind of bored. He was reading off a script. They were all given a script. All 5 of the main ministers were given a script to read. But some of these policy moves have haven't really moved the market. Then just a month ago or a few weeks ago, we had Yvonne here in Shanghai speak off the cuff, maybe it was off the cuff, but very deliberately talking about the need to combat deflation. Very rare. Do you think these policymakers are now, as policy hasn't really moved the dial yet, they're getting permission, if you will, to speak more forcefully?
Yeah, there are interesting developments in the bureaucracy. So obviously, we're seeing some of a relaxation of how we're going to stick to the growth target this year, right? So we're saying that we're going to strive our best to achieve that. And then also, as you mentioned, you can also mention the word deflation, which is quite rare. It has been a censored word on the internet. So it's rare for officials to speak out. And also, if you look at the Economist circle, right? So there are more and more economists coming out and saying, that some things has to be done, and there's a growing cause for policy stimulus. I think many of these developments are helpful, and I think it helped to bring forward this report card and many other policies initiatives. But as we said just now, right now, because the loan demand is very weak. So even if you relax the monetary policy, the effects are going to be limited, and probably the effect is more on the stock market, on the sentiment, rather than on the economic fundamentals. Physically, we have to do more. In terms of government officials, I think it's good that they come out and speak, especially Yvonne, and I think it sort of help out the discussion in the public about how the policy should move going forward.
We're also hearing more from the governor right now, on the exchange rate. So they're saying changes in global monetary policy has cut the yuan depreciation pressure. And we talk about, what does this mean for dollar China in some ways? This strength that we've seen, the PBOC has pushed back against the strength of late with the fixings. But how comfortable do you think policymakers are of where the exchange rate is right now?
Yeah, I think previously the officials are not comfortable with how weak the currency has been, because a weak currency is seen as a weakness in the country. And I think in recent weeks, the Chinese yuan has appreciated substantially from 7.4 to 7.04. And I think many people watching that, because an appreciation and also the formation of a currency appreciation expectation can bring back capital flow to the Chinese capital market, which is, what we desperately need at this stage, right? So right now we are trying very, very hard to attract capital to come back to this market. And, as you can see, because of the capital outflow problem, it's depressing the return in the Chinese capital market. And also it's decreasing the Chinese weight in many of the international benchmark indices. So right now, I think one of the key tasks really is to attract foreign capital to come back. And I think an appreciating yuan would help. So I think recent strengths in the Chinese yuan may have showed up, some of the confidence in the regulators. And I think they can do more. If the fiscal and monetary policy are strong enough to sort of reverse the downtrend, then I wouldn't be surprised to see more appreciation in the Chinese yuan coming, and that would help capital to come back big time.
How Hong, what about this pushback that they've effectively stood by the side of this bond market and said that's enough, yields can't go lower than that, and we crashed through 2% about 30 minutes back. We're a little bit above that currently. Do you think this is a signal, Ha Hong, that they're also taking a step back from intervening in this bond bull market?
Yeah, well, I think they should, sort of step back and ease a little, because the bond price is sort of traded and set by the market, right? So it's very difficult for the official to intervene. And also, this year, this market is one of the best performing savior for the Chinese market that has been under relentless selling pressure. And I think because of the housing crisis is still unresolved, the deflationary expectation is still in place. So it's very difficult for the long bond yield not to fall, right? So continue to fall and make new low. And also in China, I understand that, in the foreign Western economics, the shape of the yield curve has some sort of forward indication of where the economy is going. But I think for China, the signaling effect is very weak. I think people are just buying bond, for risk aversion rather than signaling. And I think unless we can sort of reverse the housing trend, I wouldn't be surprised to see bond yield continue to make new lows.
Steve, just I guess a final thought from you, because interesting that you mentioned, you were there, you mentioned during the NPC, you were there at the Bond Summit last week when the former PBOC governor came up and spoke and talked about deflation, which was a taboo term, as Hao was pointing out on social media. Steve, I want to get your thoughts on this briefing today. As much as it was addressing two separate maybe audiences, the local domestic economy and global investors, for example, do you feel, Steve, this was a little bit more deliberate in speaking to global investors, given the time of day, given it was live, and given how forceful some of the language was?
Yeah, I think so. Absolutely. I think the sentiment of foreign investors into China has been depressed. Obviously, they don't get the necessary transparency that they're accustomed to in the West from like the Fed officials and others. So I think there was, there was some momentum loss. Definitely in the second quarter, there was a record amount of foreign money pouring out of China. They want to stem that, obviously, here, and you can kind of see it at the International Business Leaders Advisory Council on Sunday. There was a smaller grouping. It was very positive in nature, obviously, but it was smaller in attendance. And that's something I've seen repeated across a number of different events, including the auto show and other events that I've covered so far this year. So I think definitely the Chinese officials are trying to not only address the domestic confidence issues, which is vast. Let's face it, with the property market so far down and consumption so far down, retail sales in the single digits, if at best. But the international investor is a key one, obviously.
Guys, thank you so much. Stephen Engel there, our Chief North Asia Correspondent in Shanghai for us, and Hao Hong joining us as well, Grow Investment Group partner and also Chief Economist there for their take on what was just announced, breaking news in the last hour or so. Just ahead here on the China show here, why State Street says Asia-based asset managers are, warming up to fixed income markets in the region. More on what they're seeing or where they're seeing opportunities. Just ahead, this is Bloomberg. Right, welcome back to shows. 3 Bs for you. Beijing, bold, and bonds today. With the 10-year yield briefly below 2% for the first time really on record on the Chinese 10-year yield. We have something like 350 billion north of that on auction today, so just keep an eye on that. We're obviously still coming through this Fed conversation where you're getting more officials supporting possibly a bigger cut, interest rate cut, another big one. And, of course, the BOJ and what that means as far as policy goes moving forward. And can they still hike as they get things back to when real rates are still horribly negative, getting back to neutral? Plus, I think we have a central bank decision today.
Yeah. RBA.
Yeah.
Don't forget about that. They're set to hold rates, though. But, it doesn't really change after we saw basically the Fed open the door for a lot of these central banks to cut. But it seems like the RBA in particular, they're really just focused on fighting inflation and rising housing costs here right now. So expect that Aussie to be bid up, according to some strategists that we've been talking to as well. Let's bring in Marie Tsang, State Street's APAC fixed income ETF strategist, to talk about just what we heard from this presser from China, how rare it was. Just given the fact that risk sentiment has been so weak in China, people have just been clamoring over Chinese CGBs. Does anything that came out of this, the announcements that we heard, spread that risk in any way?
I actually think it's a continuation of sort of quite supportive short-term performance for the Chinese government bonds. I mean, you've seen that on a year-to-date basis, they have been, among the highest performing of the local currency bonds because of the more accommodative stance of the central bank. But of course, longer term, it remains to be seen if these measures, will have the intended effect on the economy. So time will tell.
Okay, let's figure out what fixed income looks like these last 3 months of the yuan going into next year, where it seems to be that the pace of easing globally starting to pick up? What are some of the easy opportunities that you see?
Yeah, absolutely. And of course, the U.S. Federal Reserve was one of the last of the major central banks to ease this month. And so it's not just good news for, the traditional markets that we think of, like the U.S. and Europe, etc., but also if you think closer to home, it's also a positive for Asian government bonds as well. And the reason why I say this is because there are reasons on an absolute basis as well as a relative basis. On an absolute terms, in terms of Asia government bonds, what you're seeing there is that the central banks have more latitude to lower rates. Certainly, if currency defense was one of those thoughts, keeping rates where they are, and then you can also see gains from currency. We've already seen the US dollar strength sort of come off a little bit, soften in the second half, and if this continues, that will be a continued tailwind for Asian local currencies. And on a relative basis, the U.S. Treasury yield is getting much closer to the Asian yields.
Yeah,
US Treasury.
That's right.
There's a lot of questions of which markets benefit the most from these cuts from the Fed. You had a survey that came out maybe way before this Fed cut, of course, last week. What is sentiment like? I mean, how are people positioning around Asia bonds here right now, and what do they prefer?
Yeah, definitely. So investors are increasing their allocations to Asia ex-Japan bonds, increase of 1% of the overall fixed income allocation, the 12 months to the survey, which was earlier this year, with similar numbers of Fed cuts factored in at that point in time. And in terms of going forward, their positioning is also another increase of 1% in the next 12 months. They're going into this with their, very open to the risks, of course, that they're taking on as well. So what they're looking for in their Asia bond exposure is diversification as well. So multiple markets rather than being concentrated in a single market.
And what do you think the biggest drivers will be of performance moving forward?
I think both on the bond and currency side for these Asian local currency bonds. On the bond side, we do see more room for the Asian banks to actually ease, and that can definitely be supportive of bond pricing. And then, of course, currency, we've already seen a very good performance sort of in the second half of some of these Asian currencies, and that is potential for continuation later on this year.
Yeah, and what seems to work the most? I mean, in terms of time horizons, right? If I look at duration, for example, or even just kind of what sort of part of the curve works now?
There's quite a spread, in a survey that we conducted with 600 participants, all of whom are professional investors. Their preferences are spread out, but most interested in the 6 to 10 year sort of tenor.
Okay, so slightly more duration incrementally, almost month to month. Marie, thank you so much. It was great to speak with you, and certainly what timing to do so after the Fed and while this is going on in Beijing. Marie Tsang, of course, out of State Street Global Advisor. Speaking of Beijing, we'll leave you with a live look at that briefing, which is still ongoing. We're going on 19 minutes now out of this joint briefing in Beijing. Let's listen in.
Thank you for your question. The new Insurance National 10 articles released by the State Council has made a comprehensive and systemic plan for high-quality development of the insurance industry, and China's insurance sector is facing a rare historical opportunity. Going forward, China's insurance market will continue to expand, and its density and depth will continue to grow. Insurance funds have large-scale, long-term
We will cut the outstanding mortgage loan interest rate and unify the minimum down payment ratio. We will guide commercial banks to bring down the outstanding mortgage loans to somewhere around the mortgage rate for new home purchases. It is expected to drop by around 0.5 percentage point.
PBOC Governor Peng Gong-shan there announcing measures to support the property sector. So when it came to existing mortgage rates, that goes down and matches what we've been seeing when it comes to new mortgages. And also, second home down payment to 15%. Let's get some instant analysis from our very own Christy Hung, Asia real estate analyst with Bloomberg Intelligence. So cutting that second home down payment to 15%, how significant is that?
Yeah, so another move to cut down payment ratios have happened before for first home and second home as well. And I think the hurdle is still, it doesn't matter how much we are making it easier for people to buy a home, that won't overcome a lack of confidence. We continue to believe that we need an improved outlook on the economy, on job security, as well as on home price upsides to convince people to be confident about placing their purchase on a home. So I think we are reducing initial deposit, but that might not be the main concern for buyers for now.
The affordable, the new measures across affordable housing, so I think it's 300 billion. It used to be partially funded by the central bank. Now they're moving to make it fully funded by the PBOC. How does that exactly work, and what does that do?
Yes, so PBOC used to fund 60% of the loan. Now they're funding 100% of the loan. It means that it used to be the case that banks are lending 100 yuan for affordable housing program, and the PBOC would be paying 60 yuan of it. Now the PBOC will be paying 100 yuan of it, meaning that PBOC is now taking the credit risk away from banks and shifting it entirely to the central bank. So I think then banks won't be any more the roadblocks to this process. Banks are no longer concerned about their own credit risk, so they might be more open about lending for this affordable housing program. So this could help accelerate, because we talked about before how the 300 billion yuan fund, it used to be only 4% utilized as of end June. So hopefully this would help ramp up the process. Then I think you could see more lending being directed for this purpose. And then eventually 300 billion yuan could be used up if it's only going to be a rescue fund entirely funded by the central bank. Then the problem is then, is 300 billion yuan enough? Hopefully in the near future, that would be further extension of the quota. But I think in China, structural challenges remain, and restoring supply-demand balance remain a medium to long-term challenge.
Yeah, you mentioned in your initial reaction is that some of these announcements is still no cure to reverse this home sale slump right now. What could still change? I mean, Tier 1 cities, could we still see them relaxing property curves?
Yeah, that's another possibility. But we called it the last throw of the dice. It is really the last option in the demand-side policy toolbox. And we have seen how these measures, relaxing home purchase curbs, further lowering down payment ratios, they didn't work in Tier 2 cities in shoring up their home sales. So there is a chance that they would work in Tier 1 cities that's more resilient, but Tier 1 city at the end of the day is just 15% of national home sales. So I think that would still going to be, marginal support instead of, a full turnaround for the housing market in China.
Put that into context for us. I think that's important. Why would this be the last roll of the dice on the demand side?
Yes, because in Tier 2 or Tier 3 cities or smaller cities in China, home purchase restrictions are fully relaxed already. So they are only remaining in place in Tier 1 cities. So if Tier 1 cities are also removing, you have no other options left to stimulate demand from a policy perspective. And then also, on the other hand, down payment ratios in Tier 1 cities, they still have room to cut. But otherwise, all the other cities, down payment ratios are already raising to the minimum 15%, meaning that we think that it's unlikely the down payment would be lower further to 10% or 5% because of, there's also household leverage concerns from the PBOC. So I think from that perspective, the room for further policy stimulus would be quite limited in shoring up demand in China.
Yep, Christy Hung there on the property angle here to this multifaceted story coming out of Beijing. That is breaking news story out of Bloomberg Intelligence there. In fact, just to recap, some of the latest lines come through, and we're now over 90 minutes into this briefing. This one is coming out of, on your screens is the PBOC governor. A couple of lines coming through from the CSRC chairman, Cheng, that they will continue to support Central Huijin to raise their holdings. We're also getting a line coming through here. I think this is interesting. I think we missed this. The PBOC governor said that they will continue to rectify and punish problematic acts in the bond market. Not going into details there, but I think we could almost surmise that that would be against increased speculation in the spot market. Obviously, this, what was announced opens up perhaps possibly a new downside here, fresh downside to bond yields onshore. We're also now getting through, I think we're getting more details now on what this, I believe what the swap, oh, here we go. We now have the amounts involved here for that first batch of the swap program, and I imagine this has to do with the swap program between the PBOC and the brokers. If that is the case, I'll correct myself, it's not the case. 500 billion renminbi, and I think that is now going hot right now on your Bloomberg terminals.
Yep, okay. That's going to be a big one as well. Now that we got some numbers on that swap facility here, you can get more. T-Live Go is still happening, still ongoing here right now, with our plenty of expert editors that are still commenting and analyzing this big, big day from the PBOC. Coming up, we'll discuss JPMorgan's annual India Investment Summit in Mumbai with their global co-head of payments. This is Bloomberg. All right, as Dave had mentioned here, that yes. So there you go. They're wrapping up this press conference finally. So we're talking about a little bit more than 90 minutes that they took the questions and announced a slew of policy measures, and just quite significant there. You see the reporters now hovering around the three to take some photos. But yes, the latest line, as David mentioned, was about that swap facility there. So planning at least 500 billion renminbi of liquidity support to stocks. So does that revive the animal spirits is certainly one thing. There are a lot of analysts that we've already talked to and our team has talked to already saying, look, initially, yes, this could give a boost. The long-lasting support, though, whether that actually does sustain is another still up in the air right now.
Yeah, we need to see earnings come through. We need to see the numbers start to show the economic indicators. Yeah. And again, this goes back to several rounds of almost in a similar situation we've been here before, where you're getting quite a bit of policy support, more than expected, simply to buy us time before the economy starts to kick in. Again, that's a conversation. Markets are reacting to that. 90-minute briefing just ending right now. Very briefly, let's have a look at Nifty futures right now. So we're going into, and just keep in mind, right, so because of what's happening in China, we're now at 2-year highs, roughly, or we were, depending on the benchmark, at 2-year highs in the regional benchmark. India is at a record high. You're looking at Australia, which was at a record high on Friday. Several markets in the ASEAN region have started to kick into high gear. Like Indonesia, the Philippines entered a bull market yesterday. It really now takes us into this EM conversation.
Yeah, HSBC just downgraded Korea, right, to underweight.
Yep.
And they're pivoting more to Southeast Asia, and so it's Malaysia,
Indonesia,
Philippines as well. Let's take you to India now. And, of course, the JPMorgan India Investor Summit continues in Mumbai today as executives and investors discuss the key themes shaping today's landscape in India and beyond. And our next guest is one of the featured speakers. Max Neukirchen is Global Payments co-head at JPMorgan. Also with us is our senior editor at Bloomberg, Medika Doshi. Max, it's great to have you on. Thanks for joining us, and hope you're having a good conference so far. First and foremost, maybe just lay out for us, what is JPMorgan's current payment strategy?
Good morning from Mumbai, and thanks for having me. JPMorgan Payments, in a nutshell, is basically us helping clients accept money, hold money, send money, protect their money from any fraud, and also generate insights from the money they hold to better run their business. And we do this at a tremendous scale. We operate in about 160 countries. We process about $10 trillion a day. So we are probably one of the largest payments businesses in the world. And with that comes a important responsibility. We focus on growth and innovation to shape the payments markets, but we also very much focus on resiliency and stability, given how many companies and franchises depend on us.
Max, good morning. This is Menaka from Bloomberg in Mumbai. Welcome to the city. And let me ask you about what you make of India's progress when it comes to digital payments. It's an area the country has led in across the world. Which bits of this, from UPI to the Reserve Bank of India's CBDC experiment, which bits of this look most exciting, most promising to you?
We are very excited about the Indian market and also about being present here in India. Because it's not only a very important market for our clients, headquartered names here in India, as well as multinational companies looking to grow in India, but it's also to a good part how the future of payments globally is being shaped here out of India. UPI is a great example of a payment scheme that the government developed here that is really becoming a trendsetter around the world. There have been almost 15 billion payments processed in a single month, I think in August, and the growth is tremendous. And we really look to be here with our clients, for our clients, but also to bring those innovations out across the world, and it's really exciting to see. And UPI is a good example of an innovation that is not just a payment rail, but it created also a whole ecosystem of fintech companies that developed exciting solutions for commerce around the world. So this is definitely not the end of the journey yet, and we are very glad to be part of it.
Max, what can you tell us about your ONDC, which is the public retail e-commerce platform, ONDC product here, and how it will evolve over time? Do you expect it to be a significant business venture?
ONDC is another exciting innovation here in India that creates an open platform for commerce. And we recently announced, in partnership with ISG, a solution for our clients to access this open market for commerce here in India. And we basically provide a combination of a merchant services solution to accept consumer payments, treasury services solution that runs payouts, and a seller app to make it easy, particular for smaller merchants and also mid-sized merchants, to access the huge Indian market and sell their products on the various e-commerce platforms that are here. And we have seen already really encouraging growth of the volumes on ONDC, and look forward to the journey to continue. So it's really a great innovation and also an example of how we team up with local companies, in this case ISG, to provide very unique solutions in the market here.
Okay, I'm going to put a quick last question to you, Max, and that is how you see the global environment for cryptocurrencies move forward. India is one amongst many countries that has yet to frame regulations for crypto, in a sense, leaving it in a gray space. The US election might have the most important bearing on the future of this space, whether it is, Bitcoin-style crypto or even stable coins from here onwards. So what do you expect will be the outcome, depending on where the election goes?
We very much focus our strategy on the distributed ledger technology. We have the JPMorgan coin and other offering as part of our Onyx product and solutions line. And those allow 24/7 US dollar clearing. It's a great value add for clients that are looking for round-the-clock clearing solutions, and the new technology based on distributed ledger really has great opportunities there. We have deployed that, for example, here in India already in Gift City, in the free trade zone there, and there's tremendous client interest on this. Cryptocurrencies, on top of it, remains a very interesting and hot topic in payments. we observe the market, but our focus at the moment is on the JPMorgan coin and the Onyx solutions based on the distributed ledger technology.
Max, let's leave it there. Max Neukirchen, there, a global co-head of payments at JPMorgan, and of course the bank's big conference taking place there in India, and of course also joining us now is a senior editor, Manika Doshi, also in Mumbai for us. There's more, of course, coming up there from the Investors Summit taking place, and just on your screens coming through at those times is the co-head of global banking, Filippo Gori, joins us in the next hour to talk about sentiment around investing in China and how that might be changing moving forward. We have some breaking news, though, just to pivot here to Singapore.
Yes, this is the long-awaited corruption trial of the former transport minister of Singapore. This is Iswaran. He is facing a total of 35 charges related to corruption. And what we're hearing so far in this courtroom is that the Singapore prosecution has amended some charges from corruption. But the big one is that from the ex-minister Iswaran himself, pleading guilty to bribery charges. So this case really has been seen as a sort of a test trial for the party that has long relied on its reputation for clean governance to win all elections since Singapore's independence in 1965. So certainly we'll continue to see and watch for details coming through on this trial. Playing more ahead, this is Bloomberg.
Welcome back. You're watching the China Show. Just to recap, the ton of breaking news that came through out of Beijing, and that rare joint briefing just ended about 15 minutes back, and this is just some of the key takeaways there. So multiple interest rates being cut. There's a swap program that the central bank will open up with the brokers for them to buy stocks. It goes into this other headline, which also just came through, that China is studying. So this is something that's still in the potential oven, as they say, setting up a stock stabilization fund, and really among a series of measures aimed at, well, boosting the economy and boosting confidence too.
Yeah, it's interesting that the PBOC has unleashed this new tool, as they say, to support the stock market. And it's interesting, right? So what people are saying is this really going to help at least stabilize the market? Are we going to see something that could actually lead to some sort of recovery in equities? Some are taking it with a pinch of salt right now. We'll see. But yes, so they're basically talking about the borrowing program to stock repurchases is worth 500 billion yuan. That's larger than the one to buy up unsold homes earlier in the year, just to give you some context there. But yeah, certainly it will maybe help in some ways in terms of sentiment. But we'll see how this all plays out, obviously. Yeah. Here today.
Well, that's one central bank that did do something to another central bank that probably won't in the next hours. So we're talking about the RBA, but it's certainly what they say and how they guide and how they say it, which will be really key here. So the RBA is expected to hold rates steady today as housing costs, including rent, continue to drive or keep inflation slightly above the comfortable range. Our economics reporter Swati Pandey is with us right now to talk us through this. Swati, so why is the RBA expected to stay more hawkish than really a lot, if not all of their developed market peers?
Yes, the RBA was a little bit different. They adopted a different strategy to what other central banks did. They were cautious on the way up. They did not raise interest rates as much as others did. And one of the main reasons for that was they wanted to preserve economic growth, and they wanted to preserve the employment gains that we had during the pandemic. And they have been successful so far. They have been talking about walking that narrow path where the economy is growing, employment is growing, and inflation is gradually coming down. So they are happy for that inflationary impulse to move slowly, as long as the economy is moving in the right direction and employment growth is on. So that is one of the biggest reasons. The problem is that the last mile of inflation is really proving persistent, and we are seeing really strong services inflationary pressures. We are seeing housing costs still remaining high, and those are really problematic areas for the central bank, where interest rates not really going to do a lot, with services and housing both.
Yeah, so what are the economists, what are markets really likely going to focus on, Swati, then, in particular when it comes to the statement and the press conference that follows?
The statement is likely to be similar to the August statement. The press conference is going to provide a lot more color around what was discussed, whether the RBA discussed an interest rate hike as they did in August. Economists are saying that the case for a hike is really diminished. How can they tease that, right? So that is really a big question mark at the moment, and we will get that information at the press conference. And then the communication challenge as well, right? At a time when global central banks are cutting interest rates. We just heard about China as well. The Fed cut last week by 50 basis points. In a global backdrop like that and domestic political pressure, it is really hard for the RBA to have that, continue that hawkish rhetoric. So how they do that will also be interesting in today's press conference.
There we go. Swati, fantastic context there ahead of that central bank decision there. In Australia, our economics reporter there. You can also turn to your Bloomberg, by the way, for more on this. TLIVGO really has a lot of your big diary entries today, including this. And if you've missed all the massive news flow coming through out of Beijing, there's also an entry on that, which is still ongoing, I believe. In any case, in 90 minutes' time, we should be getting the RBA rate decision. What they do and how they say it will be key. Right, back to the big story, our top story today. The stimulus blitz coming through out of Beijing, and as it pertains to the property market, lowering the deposit ratios for second-hand homes from 25, I believe, to 15%. The PBOC also taking up all of the financing for affordable housing from 60 to up to 100%. And on top of, I think, the lowering of existing mortgage rates as well, in line with what you are to pay if you were to take out a first mortgage. As well.
Yeah, that certainly is helping the likes of, well, everything. Well, Guangzhou, RNF in particular, were up some 10%. Brokerages are definitely in focus given what we saw, this new policy tool to help boost the equity market. We talk about the swap facility. Well, we got some numbers really there talking about $300 billion just to start off with.